In business news at this hour, we continue to unpack the implications of yet another repo rate hike, while the Reserve Bank's Monetary Policy Committee has decided to hike the interest rate by 75 basis points to 5.50%. Analysts are warning of more increases to come. That's as inflation is not expected to abate due to rising fuel and food prices after consumer price inflation hit a 13-year high at 7.4%. Senior economist at F&B Commercial Property Finance, John Loos, speaks to us now about more on these developments. John, thank you as always for your time. Let's first talk about the 75 basis point hike. We are anticipating even more in subsequent MPC meetings, but at a tangible level, what does it mean for some of us who are mortgage holders and servicing car repayments?
Well, it's significant now for those who don't have fixed interest rates. The total has climbed to 200 basis points worth of interest rate hiking since last year. And of course, it's not just the interest rate hiking. The interest rate hiking is a response to the surge in inflation. So it's about petrol price increases. It's now about faster food price inflation too. Some of these, for some people, are essential. They're not always avoidable. And so it necessitates, it's two sources of pressure. It's the inflation effect plus the interest rate effect as well. And it necessitates, in some cases, a significant reprioritization of expenditure for consumers, which I expect to see away from non-essentials and also partially away from postponables. You know, those clothing and footwear items apparently, or possibly that you can postpone. You need them, but you can postpone a lot of them or work on the house, whatever it might be. So I think we're going to see quite a significant shift in priorities of many consumers in the near term.
And it's that shift and squeeze, or rather further squeeze on the consumer spending patterns that is also going to have an effect on whether inflation goes up or down in South Africa. Salaries are not meeting the expectations when it comes to our finances. I'm interested in finding out on further MPC decisions with regards to the repo rate, because many analysts are factoring in even more of an increase in the interest rate. How does that play out in the dynamics of trying to maintain inflation in South Africa, at the same time making sure that the Reserve Bank's mandate is meeting what is needed in terms of the fiscal climate in South Africa?
Well, the interest rates, our FNB team expects it to get to 10% prime rate next year. So we do still expect that there's more to come, and I think the Reserve Bank's quarterly projection model also projects more, although it's not a given that will happen. They decide every 2 months on factors at the time. So what the Reserve Bank tries to do, it can't control a lot of these inflation factors. It can't control petrol prices. It can't control global food prices. Those prices are globalized. It can't really necessarily control the rand either. But what it's trying to do now is to stem the ability of various producers all down the various production chains from being able to pass on all the cost increases, and so dampen inflation or keep inflation expectations under control. Because if it gets to a stage where the second round effects come through in the form of just everybody being able to pass on the price increases that they get from imported prices, for instance, and everybody starts to expect a higher inflation rate and just plan for it and up their prices accordingly. If they're able to do that in a stronger economic environment, then inflation expectations become anchored at a higher level and they become a self-fulfilling prophecy, and then you just have sustained inflation over the longer term. So the Reserve Bank is inflicting some short-term pain on the consumer, but it's for the longer-term good, I believe, to keep that ability to pass cost increases on by various producers and keep inflation expectations under control, and therefore bring inflation back into the target range in the not-too-distant future. So it's unfortunately short-term pain, hopefully for long-term gain.
Lastly, John, let's just quickly then talk about whether there is anything else that the Reserve Bank could have done to cushion the blow on the consumer. And I'm asking this solely around the relevance of the current mandate of the Reserve Bank.
difficult. I mean, one could argue, one can always argue that perhaps interest rates, when they were cut in the previous cycle, shouldn't have got so low because, what that obviously does is it offer, it can in many instances lead to consumers increasing their indebtedness levels. So you can always ask the question as, over the past 2 decades, should interest rates have ever got so low because they allow, more borrowing, and then when they rise, that's the problem. So I don't, it's a tough one. I mean, I think a lot of the consumer issues are elsewhere, electricity price increases, petrol prices and so on, which are really outside the control of the Reserve Bank. So, I don't think one should just believe that the Reserve Bank is solely responsible for alleviating the plight of consumers. We need structural reform to get an economy going and create jobs, and those are the type of issues really. So I think what I like about the Reserve Bank's policy these days, as opposed to say back in the 1990s, is that back then you could have 5 or so percentage points worth of hikes within about a period of 2 months in 1998. They've become a lot more gradual over the past 2 decades. They don't rapid fire hike like they used to. And I think at least that gives the consumer more chance to adjust. But there's other factors too. As I say, there's other factors causing consumer pain at the moment, which really aren't the Reserve Bank's fault or responsibility.
Absolutely. We'll leave it there. John Loos, economist at FNB, talking to us about the latest 75 basis point increase in the repo rate.